Hi everyone, I'm Ricardo Goncalves. Well, the Australian dollar took a bit of a battering today and fell to a 33-month low against the US. So to tell us more about the moves in our currency, we are joined by Attrill from NAB. Ray, appreciate your time. Run us through why we're seeing what we are seeing with the Aussie.
Well, I think there's a few factors at play here. First and foremost is that the US dollar is clearly undertaking a major cyclical turning point here. That's been evident for 3 or 4 weeks now, and that's partly in anticipation that the US Fed may not be too far away from beginning to wind down on its current quantitative easing program. So we've seen the US dollar strong and the Australian dollar is weak as the flip side of that. Also important is that we've seen a significant increase in the day-to-day volatility in currencies. So if you're a foreign investor who's been enamored of the Australian dollar because of the 2 or 3 or 4% interest rate that's on offer, but you're now at risk of losing 1 or 2% a day because of the speed with which currencies are swinging around, you're much less likely to want to be owning currencies simply because of their interest rate differential. So that's a factor too. And there's also no doubt that there is somewhat increased pessimism about the underlying health of the Australian economy, the possibility that the RBA is going to cut rates beyond the 2 3/4% cash rate that we have at the moment. So we've had a little bit of a perfect storm over the last few days, and that's why the Australian dollar has fallen as much as it has.
Ray, the market's expecting the US Federal Reserve will pull back on its quantitative easing or economic stimulus measures earlier than expected. Westpac thinks it'll happen later. What do you think?
Well, it's clear that the Fed has got what we would call a bias to taper. The Fed chairman Ben Bernanke made no attempt to push back on the suggestions that have come from various Fed officials that within a couple of months the conditions might be right for the Fed to start scaling back its quantitative easing program. At the same time, it's clear that it only takes a couple of weak US numbers, particularly with respect to employment and the unemployment rate, to set those expectations back. So our central view would be that perhaps as come September, we will see the Fed starting to scale back. But if we got the employment numbers that we're going to get this week, for example, or in the next month or two, significantly disappointed expectations and didn't show the unemployment rate continuing to trend down, then it's eminently possible that those expectations could be pushed back into 2014.
Only yesterday, Goldman Sachs brought forward its interest rate expectations, now penciling in a cut in July and later in the year. What do you think?
Well, our view at the moment is that we are going to see at least one more interest rate cut in this cycle, but our current forecast is that that won't happen until later in the year. Obviously a lot can happen between now and the next time the RBA meets. We've got our own business survey that's due to be published next week, so that will be of some interest to see whether or not the fall in the currency that we've seen in the last month and the cut in interest rates in May has had any significant effect in improving business confidence and conditions. We're also going to get some crucial employment data next week. Were they to show a significant increase in the unemployment rate, then that would certainly increase the chances, in our view, that we could see further rate cuts as early as July. But at this stage, we think it's more likely, and particularly given that the currency has fallen so fast, that the RBA is more likely to sit back for several more months at least.
So is there further weakness in the Australian currency to come?
Certainly I think the trend has changed. The question is how far and how fast it will fall. If we cast forward a few years, and let's say that the Fed has been able to fully unwind its current unconventional policy settings, then that alone would probably justify the Australian dollar being something closer to 80 cents rather than the 95 cents that we see today. In the very short term, I think there's a danger that the market has got a little bit of what we would say oversold. If the RBA is not going to deliver on another rate cut as early as July, then I think there is a chance that we will get at least a short-term technical bounce. So, we think that we could well spend a little bit more time, in this sort of 94 to 96 cent range before we do resume a downtrend later in the year.
One of the biggest questions I get asked is, what should I do in terms of the currency exchange rate? Because it's the time where a lot of Australians are about to go on their overseas holidays to escape winter here. So should Aussies be exchanging right now if they're going for a European or American summer?
Well, perhaps the best advice at the moment would be to contemplate spending summer holidays here in Australia. But for those who are dead set on going, given that the risks, I think, are that the Australian dollar will fall somewhat further and faster than we currently expect, then if you do have the cash in the bank to pay for your summer holiday spending, the advice would probably be to translate it sooner rather than later.
Okay, Ray Attrill from NAB, appreciate your time.